Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at Amazon.com Incorporated, ticker AMZN. Now, we last took a look at it in February of 2024, and at that point, I came up with a fair value of $162 and an annual growth rate of about 11.5. Today, I'm coming up with the value of 171.5 with annual growth rate of 13. So I wanted to take a look again at the fundamentals, and then I do want to focus on the technicals mostly with this one because that is where I make a lot of my money. I'll tell you what I'm looking at for this stock, or at least what I would look at for this stock if it was something that I was wanting to buy and I wasn't wanting to pay the current price, because it's currently trading for $222. It's been as low as 161 and as high as 242. But I'm coming up with 171.5 for my fair value. With the growth rate that we come up with this thesis, the 1 year price target would be somewhere around 193. So that is a bit more reasonable, a bit closer to today's market value. Looking through the fundamentals, I know they do more than just retail. They have AWS, they have Prime, but there's nothing incredible here. It's almost like retail statistics. Like, cash flows recently went positive. That's what's kind of hard about this one, is they turned a leaf and they're now positive in cash flow and in earnings. So it's a bit of a different story. That's why you see a negative cash flow growth here, like a crazy negative number, because they went from negative to positive. So on average, they're at 1%. This last year, they were at 5%. I'd like to see them get up to something in the realm of their net margins, which should really be above 10%. But their growth's a little uncertain in the path there. ROE looks really good, almost 21%. Their debt to equity, maybe a little high, 1.2, but that's not that bad. Maybe skewing this a little bit. ROI is pretty low, though, 5.7, and ROA, 9.5. So they're not getting very good returns on their investments or their assets. We like to see double digits, or that's what we've seen amongst a lot of the other FANG stocks. Gross margins look decent, 48.85, up from the 45.42 that we've seen previously. And net margins, 9.29, up from 5.29. So things are all trending in the right direction. PE, I feel like the PE is very heavy on this one. 33.6 currently, which is kind of the lowest that we've seen in the past 5 years. For my calculations, I used a 32 PE because otherwise it's incredibly overvalued. It seems more reasonable like this. A year ago, I wasn't trying to calculate PEs and stuff. I was just using their average of the 5 years. So I was likely using something in the 40s. The market's pulled back a little bit, brought it down to the mid to lower 30s, and as have my calculations. But really, if you're getting a 13% annual growth rate, then your PE should be 25. I feel like would be a bit better. But maybe I'm underestimating it. And if I am, 13% might be low. So we'll start with the revenues as usual. This one's typically pretty easy. 10.7 over the last 3, 11.4 over the last 2, analysts projecting 11 for this next year, and 10.6 for the next 2 years. 10 to 11, it's pretty easy to fill in a revenue here, unless they start slipping from the growth rate that they're currently on. Share count, this is the main thing that's holding them back. Over the last 3 years, 1.33. Over the last 2, 1.7. I'd like to see them slow it down. Ideally, this goes negative where they're buying back shares, especially with no dividend and their cash flows going positive. It's likely all stock-based compensation trying to attract good talent, but it just sucks for investors. So 1.5 is like right in between what we've seen out of them historically, lower than what they came into the last 2 years. And that's going to take away from your returns as a shareholder and dilute every single metric, which further takes away value from you as a shareholder, which is one of the reasons why I probably won't buy this stock. Margins are too low. and they're issuing shares are my two biggest things. ROI and ROA are way lower than everything else that we've looked at. Like this is where I track all of the stocks that I've analyzed, and this is my watch list. So lately, I've been putting in margins over here when I analyze a stock. I wasn't doing that previously, but you can see, of course, I'm going to go for something with a higher margin and is undervalued. Like right now, I've been buying a lot of NVIDIA. I think NVIDIA is at least a $200 stock. It's definitely starting to reach that way. I swear it's up 2-3% every single day. Annual returns were crazy, 5.3, a little bit of a dividend, which puts it at 42% undervalued for the 1 year time frame based on the current market value. Then we have Palo Alto. I've been buying quite a bit of that. Fair value is 175, currently trading for 209, but the annual growth rate 28%, which puts it about 12% undervalued in the 1 year time frame, and it has an over 30% margin. So Amazon would fall on this list just below Equifax. Now Equifax is overvalued in my opinion. Fair value 175, currently trading for 232. Annual return 9.88, so not a growth stock, kind of just in line with markets, and a bit of a dividend, but it's so overvalued with slow growth that I don't think it's worth buying. So just a quick look. Look at everything that's positive. So these are all the stocks that I believe are undervalued in the 1 year time frame. Let's sort from smallest to largest. Google is on the brink. It's like right at its 1 year price target based off the annual growth with 28.5% margins. And we have Microsoft, Ferrari. I just did the video on Adobe. Adobe is a good value stock. Look at this, 30.71 with 26% margins. If I had to pick between Amazon and Adobe, I would pick Adobe. I'd pick NVIDIA. I'd pick Palo Alto. I would probably pick Ferrari too. Ferrari's getting really close to the 1 year price target for me. But that's what I do to track all the stocks and how I look at it. When I say that there are better options, that there are those other options. Cash flows, I was just trying to get this cash flow yield up. 15%, that's 5%, or that's more than 4% over their revenue growth, which should get that yield up. That only brings them to 6.2. Really, that needs to get up to 10 if that's where their net margins are going to be. And it'd just take a lot to get there. So we'll have to see how that plays out. These returns aren't bad for these numbers either. It probably could be better. Assets, 15%. So we've seen 14 and 16, 15 right in the middle. Liabilities, 6, 3, so 4.5. That's what I'm going with. They don't have a dividend. Margins, I'd like to see them get above 10%, as I said. Well, maybe 4% is a little high. Maybe we take that down to 3.5, brings them to 11% in the next 5 years. Still, your annual returns are about 13%. So buying at today's price, not looking too good. In 3 years, the fair value at this growth rate is about 196. So that's 12% lower than today's price. Now, it could be still trading at 3 year out values. There's a massive multiple on this, as I said, with the PE ratio. Huge multiple on this one. Probably going to dwindle down over time, but you could be still trading at 2 years out, which means in 3 years, you might see the stock worth 246%, which is 11% higher than the current price. And you'd be underperforming the market by 15%. So today's price is just not a good price to get in, my opinion, not into this stock. And that's why I wanted to take a look at the technicals for the stock. And we can see how it is performing there. Because I make the majority of my money off of trading. Last month, I made $4,300 off options trades. And I see kind of setup that I'm looking for on this stock. This green line down here, this is what I think the fair value is. So we have a massive support down here below the fair value, where we last saw it in the beginning of April. It touched down to these lows. Only had one single candle where it's broken below since the start of 2024. And you can see that single candle. There's some crazy days on this stock, because this is a green candle, right? Which means this day we opened here, had all of that activity, closed here. The next day we opened here, way down below, and basically pushed up to close essentially at this support. And then it just took off from there. And it's also right at the top here before we gapped up. So some crazy support at that level. That's $160 if you can find it for that. Fair value, unlikely to break below based off current market behavior. None of this is guaranteed. If news, forecasts, whatever changes with the company, these lines could be meaningless. But with just market action, assuming no other news, this is what we're looking at here. So we see there's a massive long-term uptrend here going back to the start of 2023. And we got a few touch points way down there. It broke above, almost came down and touched a few times, but most recently that low. And at this point, there's still quite a bit of room above that. So I put a shorter term uptrend. Now we've got these last two drawdowns. Start the formation of this trend line. And then it just so happens that we're currently resting like right above it too. So if we break below this, we have another support down here. You can see it topped out there. It's topped out there quite a few times and then needed massive spikes to break past it. Also, we haven't been below it since this massive gap. I mean, there was one day where price action opened below and came right back above. So again, that just shows you that there's massive support there. So what I'm looking at is, if we break this trend line, we could dump all the way down to that support of 200. And my 1 year price target on this one is about 194. So I was looking at the options chain. And if I go out to the end of the month, 31st, for a $195 put, premiums are currently $1.37. So you'll get paid $137 if you sell this put. You could then buy the 190 put up $500 in collateral, collect about $50 in premium, so a 10% ROI. If the market tanks down to 194 or below, you could then sell the put that you bought, hopefully at a higher price, assuming it didn't take too long for the price to come down. And you could pick up the shares through assignment for a break even on your shares of $194.50, plus whatever premium you collect with the other option. And if the market, if it goes up, if it hits this trend line again, continues to push, massive resistance way up here at the $240 range. I mean, it's tested it twice so far. It's going to really need some momentum to break through. But you would collect that 10% ROI, $50 over the course of the month. So that's how I look at a stock like this, and how I try to make the most out of my money. And really, that's all that I'm looking at with this stock. Like I said, there are better options, but for the trade, though, that's not a bad trade. I think you'll most likely end up taking the 10% ROI. If you have $20,000 and want 100 shares, then it's even better. You saved yourself 2.5K and got it at the price that you'd like. So that's what I'm seeing on this one. I'll update the watch list, get the margins and everything else in there, and keep an eye on it. It's an interesting one, kind of tough because they're in so many different businesses, but I do think that they've got room to grow with their cash flows, their margins, everything. So I want to thank you guys for watching. Please like, enjoy the video, comment what other stocks we should take a look at, and subscribe so you can stay up to everything. And I'll catch you next time.